Okay, welcome to the part 3 of today's lecture. In this part, we will be solving two problems. In the first problem, we will be calculating the correct inventory amount and we will be considering the goods in transit and consignment. So, let's read the problem first. So, the December 31st, 2018, the year-end inventory balance of the Raymond Corporation is 210,000. You have been asked to review the following transactions to determine if they have been correctly recorded. So be careful about this. So we will be working for the Raymond Corporation. So we should be careful about whether the Raymond Corporation is the buyer or the seller, or whether the Raymond Corporation is the consignee or consignor. Okay. So let's read the first one, the problem. So the goods shipped to Raymond. So it means that goods have been shipped to Raymond. Here it means that Raymond is the buyer. Okay, and the term was pre on board destination, and it was shipped on December 26, 2019, and the Raymond has received the goods on January 2. So the cost was 30,000, and it is included in Raymond's preliminary inventory balance. So what should we do? So think about it. Think about this, that Raymond is the buyer and the term is pre-onboard destination. We know that in case of pre-onboard destination, the ownership of the goods in transit goes to the seller. So we will subtract this one. That is why I put negative here. Okay. Now, number 2, at the year end, Raymond held 14,000 of merchandise on consignment from Harrison Company. So here, see, the Harrison Company is the consignor, and we know that uh, the goods held on consignment is usually owned by the consignor. So here, the Harrison Company is the goods, is the owner of the goods of 14,000. So this merchandise has been included in the preliminary inventory balance of Raymond. So what should we do? We should subtract this one, okay, from Raymond's inventory. And number 3, on December 29, merchandise costing 6,000 was shipped to customer. Uh, Free on board shipping point and arrived at the customer's location on January 3, 2020. So the merchandise was not included in the preliminary inventory balance. Okay, so here uh, merchandise was shipped to a customer free on board shipping point. Okay, see the shipping point, and here uh, since the goods were shipped to a customer, so Raymond Corporation is the seller. So in case of shipping point, the goods in transit is owned by the buyer. So we don't need to do anything. Okay. So it is okay. We are writing okay. Meaning we don't need to adjust this one. And the final one. At the year end, Raymond had merchandise costing 15,000 on consignment with Jacqueline Corporation. Okay, see, in this case, Raymond is the consignor. So 15,000 of the goods is owned by Raymond. So the merchandise is not included in the preliminary inventory balance. So we should add this one. Okay, we should be fine. So let's solve this one. Let's solve the problem. Let's start with, so let's start with the first one is inventory balance before adjustment. Okay. Oh, before adjustment it is to 110,000, and then what do we do? Add which one? Add number 4. Okay. So add the merchandise held on consignment, okay, with Jacqueline, with Jacqueline Corporation. Okay. So how much is that? That is 15,000. So what I'm gonna do, and then subtract. What do we subtract? Subtract number one, merchandise shipped to Raymond, free on board, destination on December 26, and that is 30,000. Okay, and the other one is the second one. Second one is, so merchandise held on consignment from Harrison Company, and that is 14,000. Okay, so underline, and after adding and subtracting, we find 181,000. Okay. Okay. So this is the correct inventory amount. Correct inventory balance. Okay. I hope you got this one. Okay. So this is the answer. So if you have any question, let me know. I'm just deleting this. Let me delete. Okay. So now let's go to the problem number 2. Okay. So in this problem, let's read the problem first. Let me make the font a little bit higher, bigger, so that we can see. Okay. So what I'm gonna do? So James Company began the month of October with the inventory of 15,000. The following inventory transactions occurred during the month. Okay. So see, the company purchased merchandise on account for 22,000 on October 12th. The terms of the purchase were 2, 10, and 30. It means if you pay within 10 days, you will get 2% discount, and within 30 days, you need to pay the net amount. James uses the net method to record purchase. The merchandise was shipped free on board shipping point, and freight charges of 500 were paid in cash. Okay, and in this case, see, we should be careful about it is free on board shipping point. Okay, if it is free on board shipping point, the ownership of the goods uh, in transit goes to the buyer, and the buyer needs to pay the freight charge. Okay, so we'll be working on this in this one. And October 31st, James paid for the merchandise. Okay, so the James has purchased on October 12, and they paid October 31st. So actually they paid after the discount period, cash discount. So this during October, merchandise costing 18,000 was sold on account for 28,000. So we will be recording the sales, and it was determined that the inventory on hand at the end of the October was this amount. Okay, and there are two requirements. Number one, assuming that James Company uses the periodic inventory system, okay, prepare the journal entries, and the company uses the perpetual inventory system, we will be recording the transactions. Okay, so let's start. So the first one, first thing first. The first one, this is requirement. Okay, let me see. Requirement 1. Okay, it is saying we will be using the periodic inventory systems. Okay, let's write it. Periodic inventory system. Okay, so what do we do? The first one, the company purchased. Okay, we need to record the purchase, and they follow the net method. Okay, so let me change the color of the font. Okay, and I think it will follow the first one. Purchase. I think no, this is not a good color. Yeah. Purchase debit. It should be 22,000 multiplied by 98% because we are following the net method. Okay, and it is equal to 21,560 debit, and accounts payable 21,560. Okay, this is to record credit purchase. Okay, and then say this is pre-on board shipping point and freight charge was 500, so we need to pay the freight charge as well. So let's pay the freight, record the freight cost, actually freight in debit, that is 500, and we paid in cash 500. Okay, I hope you got it. So we should be so to record freight cost. Number B, where it is. So number B, October 31st, James paid for merchandise. Say the difference. The original cost was 22,000, but we have recorded the purchase accounts payable as 21,560. Okay, so we assume that we will be paying within the 10 days, but we could not. Okay, so we have actually lost the discount. Okay, so we need to record this one as accounts payable red debit. How much? 21,560. Then for the amount of discount that we have missed to take, so we will be recording interest expense debit, that is 440, and we have paid the entire amount in cash, so that is 22,000. Okay, so this is to record payment after discount period. Okay, then to record sales on accounts. Okay, number C, it is very simple. So that is when we have recorded sales during October. Actually, this is during October. So 10, we can write say 10/31st. Okay, during October. So during October, we have sale of 28,000. Okay, so accounts receivable debit, that is 28,000 and sales revenue 28,000. Okay, and we are writing two records credit sales. Okay, and note is that I write no journal entry is required for cost of goods sold. Okay, we are done with this part. And we will be recording the cost of goods sold in this part. So what we have, see, in this problem the beginning inventory was 15,000. Let's start with the beginning inventory. So beginning inventory is 15,000. Then we'll be adding purchase was 21,560. We have recorded this one, and plus freight in, because the freight in is the part of purchase. So our total purchase is gonna be, say, 22,000, sorry, 60. Okay, now so the sum of these two is gonna be our 37,060. It is called cost of goods available for sale. Okay, so now then less any inventory, so that is, sorry, 19,060. Okay, it's given, so this one, and finally cost of goods sold is equal to, it should be 18,000. Okay, double line, so we are closing this one, and the final adjusting entry would be, so the final adjusting entry would be cost of goods sold debit change the color. Okay, the cost of goods sold debit, how much? The cost of goods sold we have just calculated 18,000. Then ending inventory, inventory ending, and then inventory beginning, that is equal to, okay, beginning inventory is credit, so that is 15,000. You already know about this. And purchase, the purchase is equal to 21,000. We have recorded this one initially, and freight in, that is 500. Okay, this is to record adjusting entry for inventory. Okay, this is how we record it. And under the perpetual inventory system, see requirement 2, it is almost similar. same thing. And to record the payments, see the almost same thing, accounts receivable, but this is the difference. We have calculated the cost of goods sold 18,000 here. Here it is. So we'll be recording this one, and that's it. Okay. So I'm uploading this one as well. Okay. So thank you so much.